Fuel prices are already high across the United States. By late April 2026, the national average had moved into a range of roughly $4.18 to $4.23 per gallon, with some regions approaching significantly higher levels. For households, that number is immediate and visible. It is the cost paid at the pump, repeated week after week, with little indication of when it might decline. But the more important shift is not happening at the pump. It is happening inside the system that determines how fuel moves from production to consumption. And within that system, one of the most important layers is beginning to weaken. Fuel inventories are falling. This change is not isolated to a single category. It is occurring across gasoline, crude, and diesel at the same time. According to data from the U.S. Energy Information Administration, gasoline inventories declined by approximately 6.1 million barrels. Crude inventories fell by about 6.2 million barrels. Diesel supplies dropped by roughly 4.5 million barrels. These numbers describe more than a short-term fluctuation. They indicate that the system is drawing down its reserves across multiple points at once. To understand why this matters, it is necessary to look at what inventories actually do. Fuel inventories are not simply excess supply stored for later use. They serve a structural role within the energy system. They exist to absorb imbalance. When production does not fully meet demand, inventories fill the gap. When production exceeds demand, inventories are rebuilt. This continuous adjustment allows the system to operate without abrupt changes in availability or price. Inventories provide time. They allow the system to respond gradually to changes in supply and demand instead of reacting immediately. When inventories are sufficient, disruptions can be absorbed without significant impact on the consumer. When inventories are reduced, that ability begins to disappear. By mid to late April, the data showed that this buffer was being used at an increasing rate. At the same time, the conditions that required the use of that buffer had not yet been resolved. Earlier in the month, refinery disruptions had reduced output by approximately 800,000 barrels per day. Facilities associated with Marathon Petroleum, Phillips 66, and BP experienced outages that limited the amount of fuel being processed. This reduction in refining capacity meant that less gasoline and diesel were entering the system on a daily basis. Demand, however, did not decline in response. Commuting patterns remained consistent. Freight continued to move. Distribution systems operated without interruption. The system was required to maintain supply even as production was reduced. The difference between those two conditions was absorbed through inventories. Stored fuel was used to maintain continuity, allowing the system to continue functioning without immediate disruption at the retail level. Gas stations remained supplied. Consumers continued to purchase fuel. The visible part of the system appeared stable. But the stability was being supported by reserves that were steadily declining. This is the role of inventories during periods of constraint. They allow the system to continue operating, but they do not eliminate the underlying imbalance. They postpone its effects. As inventories decline, the system begins to lose that ability. This is where the current condition becomes more significant. The declines in gasoline, crude, and diesel inventories are not occurring in isolation. They are occurring simultaneously across multiple categories of fuel. This suggests that the system is not experiencing a localized issue. It is operating under broader pressure. Each category of inventory serves a different function. Crude inventories represent the raw input for refining. Gasoline inventories represent the finished fuel used by consumers. Diesel inventories support freight, logistics, and industrial activity. When all three begin to decline at the same time, the system loses flexibility at multiple levels. It has less raw input available for processing. It has less finished fuel available for immediate consumption. It has less support for transportation and distribution. This multilayer reduction creates a condition where the system becomes more sensitive to change. Sensitivity in this context means that smaller disruptions produce larger effects. When inventories are high, the system can absorb fluctuations. When inventories are low, those same fluctuations have a more direct impact. This is not immediately visible as a shortage. Fuel remains available. Transactions continue. The system does not stop functioning. But the margin for adjustment becomes narrower. There is less room to absorb additional pressure without affecting price. At the same time that inventories were declining, another factor continued to influence the system. Exports remained elevated. Crude oil exports were measured at approximately 6.44 million barrels per day. Total fuel exports reached around 14.18 million barrels per day, representing record levels for the period. These flows continued to move fuel out of the domestic market while inventories were already being drawn down. Exports are part of normal market activity. The U.S. fuel system operates within a global market, and fuel moves across borders in response to demand. However, the impact of exports changes depending on the condition of the domestic system. When production is stable and inventories are sufficient, exports do not create significant pressure. The system has enough capacity to meet both domestic and international demand. When production is constrained and inventories are declining, exports contribute to the tightening of supply within the domestic market. This does not mean that exports are the primary cause of the imbalance. It means that they reinforce existing conditions. As fuel leaves the system, it reduces the volume available for internal use. When inventories are already being used to compensate for reduced production, this outward flow increases the rate at which available supply declines. The system becomes more dependent on current production. However, current production remains constrained due to earlier refinery disruptions. This interaction between reduced production, declining inventories, and sustained exports creates a consistent pattern. Fuel is entering the system at a reduced rate. Fuel is leaving the system through both consumption and export. The difference is being absorbed by inventories. As inventories decline, the system loses its buffer. This is the point at which the condition begins to change. The system is no longer absorbing imbalance smoothly. It is becoming more reactive. This change in behavior is reflected in pricing. When inventories are sufficient, prices can stabilize after an increase. The system has time to adjust. When inventories are reduced, that time disappears. Prices respond more directly to changes in supply because there is less stored fuel available to offset those changes. For households, this shift is experienced as persistence. Prices rise and remain elevated. They do not return quickly to lower levels because the underlying conditions that support those lower levels have not been restored. At the same time, the system's reduced flexibility introduces uncertainty. When inventories are low, prices can change more frequently. Small disruptions can produce noticeable effects. The range of possible outcomes becomes wider. This makes it more difficult to anticipate future costs. Budgeting becomes less predictable. Expenses that were once stable begin to vary. The impact is not limited to fuel purchases. It extends into other areas of spending as transportation costs influence the pricing of goods. This transmission of cost is gradual but consistent. Higher fuel costs increase the cost of moving goods. Over time, those costs are reflected in retail prices. The effect spreads through the economy, affecting multiple categories of spending. At this stage, it is not necessary to speculate about future developments. The current data already describes the condition of the system. Inventories have declined across gasoline, crude, and diesel. Refining capacity remains constrained. Exports continue at elevated levels. Each of these factors contributes to the same outcome. The system is operating with less buffer. That reduction in buffer changes how the system responds to pressure. It becomes more sensitive, more reactive, and less stable. For households, the result is already visible. Fuel costs remain elevated. Price movements are less predictable. The broader impact of those costs continues to develop. This is not a temporary fluctuation that resolves quickly. It is a structural condition that persists until inventories are rebuilt and production returns to normal levels. At the end of April and into early May, those conditions had not yet been achieved. The system continues to operate, but it does so with reduced flexibility, and that is the starting point for understanding why prices remain high and why the system behaves differently under pressure. As inventories continued to decline through April, their role within the system began to change in a more fundamental way. They were no longer functioning as a temporary buffer that could absorb short-term imbalances. Instead, they became a primary source of supply that the system depended on to maintain continuity. This shift is important because it alters how the system responds to pressure. Under normal conditions, inventories are replenished as quickly as they are used. When production exceeds demand, the excess is stored. When demand exceeds production, that stored supply is released. The system remains balanced because inflow and outflow are aligned over time. By mid to late April 2026, that alignment had been disrupted. Production had already been reduced by approximately 800,000 barrels per day due to refinery outages. That reduction limited the amount of new fuel entering the system. At the same time, demand continued at a steady pace, requiring a consistent level of supply. The difference between these two conditions was absorbed through inventories. As a result, inventories declined across gasoline, crude, and diesel simultaneously. Gasoline inventories dropped by approximately 6.1 million barrels. Crude inventories fell by about 6.2 million barrels. Diesel supplies decreased by roughly 4.5 million barrels. This pattern indicates that the system was not only using its reserves, but relying on them in a sustained way. When inventories are used continuously without being rebuilt, the system begins to lose its capacity to stabilize itself. Each additional unit of fuel consumed comes from a smaller remaining pool. The margin for adjustment becomes narrower. At the same time, there was no indication that refining capacity had fully recovered. The earlier loss of approximately 800,000 barrels per day remained a constraint on production. Even with refinery utilization at around 89.6%, total output remained below what would be possible under full capacity. This means that the system could not easily replace the fuel it was using from storage. The interaction between these two factors, declining inventories and constrained production, creates a reinforcing effect. Reduced production limits supply. Lower supply increases reliance on inventories. Declining inventories reduce the system's ability to absorb further imbalance. Each step increases the sensitivity of the system. As this sensitivity increases, the system becomes more reactive. Changes that would normally be absorbed gradually begin to produce more immediate effects. Prices adjust more quickly because there is less buffer to moderate those changes. This is the environment in which fuel prices remained elevated. At the same time, exports continued at elevated levels, adding another layer to the system's behavior. Crude oil exports were measured at approximately 6.44 million barrels per day. Total fuel exports reached around 14.18 million barrels per day. These figures represent sustained outward flow from the domestic system. Exports are not an unusual component of the market. They are part of how fuel is distributed globally. However, their impact depends on the condition of the system at the time they occur. When inventories are sufficient and production is stable, exports do not create significant pressure. The system has enough capacity to meet both domestic and international demand. When inventories are declining and production is constrained, exports reduce the amount of fuel available within the domestic system. This reduction does not immediately create shortages, but it contributes to the overall tightening of supply. The system must meet the same level of domestic demand with a smaller available pool of fuel. This interaction between exports and inventories is particularly important. As fuel is exported, it leaves the domestic system. When inventories are already being used to compensate for reduced production, exports increase the rate at which those inventories decline. The system becomes more dependent on current production, which remains constrained. This creates a feedback loop. Lower inventories increase system sensitivity. Exports reduce available supply. Reduced supply increases reliance on inventories. Each factor reinforces the others. At this stage, the system is no longer operating with a stable balance between supply and demand. It is operating with a reduced margin for adjustment. This reduced margin changes how the system behaves over time. Instead of absorbing fluctuations, it reacts to them. For households, this change is experienced as persistence in fuel costs. Prices that have already risen do not decline quickly because the underlying conditions that would allow for that decline have not been restored. The expectation that prices will fall after a disruption depends on the system regaining its flexibility. That requires inventories to rebuild and production to return to full capacity. By late April, neither of those conditions had been achieved. Inventories continued to decline. Refining capacity remained constrained. Exports continued at elevated levels. The system remained under pressure. At the same time, the structure of the system explains why this pressure is not immediately resolved. Crude production remains stable at approximately 13.6 million barrels per day. This indicates that the availability of raw oil was not the limiting factor. The constraint existed at the refining stage, where crude is converted into gasoline and diesel. This creates a bottleneck. The system has access to raw input, but its ability to process that input into usable fuel is limited. As long as that limitation exists, increasing crude production does not directly translate into increased gasoline supply. The presence of this bottleneck reinforces the importance of inventories. Inventories provide the flexibility needed to manage the difference between available input and finished output. When inventories decline, that flexibility is reduced. This is why the system becomes more sensitive even when upstream production remains stable. For households, the distinction between crude production and gasoline supply is not immediately visible. What is visible is the cost of fuel at the pump. However, the behavior of that cost is determined by the balance between refining capacity, inventory levels, and the flow of fuel within the system. By late April, that balance had shifted. The system was operating with less capacity, fewer reserves, and sustained outward flow. This combination affects not only the level of prices, but also their stability. When inventories are sufficient, prices can stabilize after an increase. When inventories are low, prices are more likely to remain elevated because the system cannot easily rebuild supply. This explains why prices above $4 per gallon persisted. It is not simply the result of a single disruption. It is the result of multiple constraints interacting at the same time. At the same time, regulatory oversight continued to operate within this environment. Investigations in states such as California and Nevada focused on whether price increases at the retail level were consistent with underlying costs. These investigations were triggered by consumer complaints and localized price spikes. The process involves comparing wholesale fuel costs, transportation expenses, and retail prices to determine whether margins have expanded beyond expected levels. However, the presence of these investigations does not change the underlying structure of the system. Prices can rise rapidly in a constrained environment without violating regulatory standards. The determining factor is whether those increases reflect actual cost changes. For households, the distinction between system-driven price increases and potential pricing behavior is not always clear. The price at the pump reflects the combined effect of both. By the end of April, the broader pattern had become established. Refining capacity remained reduced by approximately 800,000 barrels per day. Inventories had declined across gasoline, crude, and diesel. Exports continued at elevated levels. Prices remained above the $4 threshold nationally. These elements are interconnected. They describe a system operating with less supply relative to demand and with reduced ability to absorb change. This condition does not resolve immediately. It persists until the underlying factors begin to shift. For households, the result is a continuation of elevated fuel costs and reduced predictability in pricing. The system remains active, but it operates under constraint. And that constraint continues to shape how prices behave and how those prices are experienced in everyday life. By early May 2026, the pattern that had been building throughout April had not reversed. The system had not regained its balance, and the same pressures that drove prices higher were still in place. Refining capacity remained below its previous level. Inventories had been drawn down across gasoline, crude, and diesel, and exports continued to move fuel out of the domestic market at elevated rates. These conditions define the structure of the system at this point. The significance of declining inventories becomes more apparent when considered in the context of how the system maintains stability. Inventories are not simply a reserve of fuel. They represent the system's ability to manage imbalance. When inventories are sufficient, the system can respond gradually to disruptions. When inventories are reduced, that ability is diminished. By late April, gasoline inventories had declined by approximately 6.1 million barrels, crude inventories by about 6.2 million barrels, and diesel supplies by roughly 4.5 million barrels. These declines represent a sustained use of stored fuel across multiple categories. At the same time, the capacity to replenish those inventories remained constrained. Refinery disruptions had reduced output by approximately 800,000 barrels per day, limiting the amount of new fuel entering the system. Even with refinery utilization at around 89.6%, total output remained below full capacity. Crude production continued at approximately 13.6 million barrels per day, indicating that the availability of raw input was not the limiting factor. The constraint remained at the refining stage, where crude is converted into usable fuel. This combination creates a structural condition. The system has access to raw material, but its ability to process that material into finished fuel is limited. As a result, the supply of gasoline and diesel remains constrained even when crude production is stable. At the same time, exports continued to draw fuel out of the domestic system. Crude oil exports were measured at approximately 6.44 million barrels per day, and total fuel exports reached around 14.18 million barrels per day. These flows represent sustained outward movement of fuel during a period when inventories were already declining. The interaction between these factors is not temporary. Reduced refining capacity limits supply. Declining inventories reduce the system's ability to compensate. Exports reduce the volume available for domestic use. Each factor reinforces the others. This creates a condition where the system operates with less flexibility and greater sensitivity to change. In such a system, prices do not adjust in the same way they would under stable conditions. When inventories are sufficient and production capacity is intact, prices can rise and then stabilize as supply adjusts. When inventories are low and production remains constrained, prices are more likely to remain elevated because the system cannot easily rebuild supply. This explains why fuel prices that have already risen above $4 per gallon have not declined in a sustained way. The conditions required for that decline have not yet been restored. Inventories would need to begin rebuilding. Refining capacity would need to return to normal levels. The balance between supply and demand would need to stabilize. By early May, none of these conditions had been fully achieved. Instead, the system continued to operate within the same constraints that developed earlier in the month. For households, this condition is experienced as persistence. Fuel costs remain elevated over time. They do not fluctuate within a narrow range or return quickly to lower levels. Instead, they reflect the underlying imbalance between supply and demand. The effect of this persistence extends beyond fuel purchases. Fuel is a foundational input in transportation. As fuel costs remain elevated, they influence the cost of moving goods. Over time, these transportation costs are reflected in the price of goods and services. This transmission is gradual, but it is consistent. Higher fuel costs increase the cost of logistics. Higher logistics costs influence retail pricing. Retail pricing affects household expenses across multiple categories. The result is a broader impact on the cost of living. At the same time, the reduced flexibility of the system introduces uncertainty. When inventories are low and production is constrained, prices can change more frequently in response to relatively small shifts in supply conditions. This makes it more difficult to anticipate future costs. For households, this uncertainty affects budgeting. Expenses that were previously stable become more variable, the range of possible outcomes becomes wider, and the ability to plan for future costs becomes more limited. This is not a temporary adjustment. It reflects the current structure of the system. Regulatory oversight continues within this environment. Investigations in states such as California and Nevada remain focused on whether price increases at the retail level are consistent with underlying cost changes. These investigations involve comparing wholesale prices, transportation costs, and retail pricing to determine whether margins have expanded beyond expected levels. By early May, no large-scale penalties had been confirmed. The investigations remained ongoing, reflecting continued monitoring rather than completed enforcement actions. This indicates that while price increases have been significant, determining whether they exceed cost-based justifications requires detailed analysis. However, the presence of these investigations does not alter the underlying drivers of the market. The primary factors shaping price behavior remain tied to supply, inventories, and the flow of fuel. At this stage, those factors remain unchanged. Refining capacity has not fully recovered. Inventories remain below previous levels. Exports continue at elevated rates. These conditions define the current reality of the system. For households, the impact is already present. Fuel costs remain high. Price movements are less predictable. The broader cost of living continues to reflect these conditions. The system continues to operate, but it does so with reduced capacity to stabilize itself. That reduction in capacity is not visible in a single data point or a single event. It is reflected in the interaction between production, inventories, and distribution. It is reflected in the persistence of higher prices, and it is reflected in the way those prices affect everyday expenses. This is where the system stands. It has not returned to balance. It has not rebuilt its buffer. It has not regained the flexibility required for prices to decline in a sustained way. The conditions that developed through April remain in place, and as long as those conditions persist, the system continues to operate under pressure. That pressure is not temporary, it is structural, and it defines the current state of the fuel market.